The financial landscape of 2026 is nothing like what our parents faced. If you were following advice from 5 years ago, you were already behind. We are living in an era where traditional savings accounts are essentially lockers where your money goes to die. With global inflation hovering at a persistent 4%, holding cash is a guaranteed way to lose wealth. I wish I knew earlier that saving is actually a risk. To survive today, you must transition from a consumer to an owner. Whether it is fractional real estate, decentralized finance, or automated index funds, the barrier to entry has vanished, but the complexity has exploded. You cannot just buy and hold everything anymore. You need to understand the macro environment. This year, the difference between the middle class and the wealthy is defined by one thing: financial literacy. If you do not understand how the dollar is being devalued, you will continue to work harder for a currency that buys less. We are diving deep into the mechanics of 2026 because the old ways are officially broken. It is time to stop playing defense with your bank account and start playing offense. Every dollar sitting idle is a soldier you have failed to put to work. You need to realize that the global economy is shifting toward digital assets and automation. If your portfolio does not reflect the world as it is today, you are betting against progress. I spent years thinking that playing it safe was the way to win. But in 2026, playing it safe is the fastest way to go broke. You must embrace calculated risks and understand that volatility is not the same thing as danger. The truth is that the wealthy use inflation to their advantage while the uninformed are crushed by it. Let us change which side of that equation you are on. The biggest mistake I made starting out was waiting for the perfect moment to enter the market. I thought I was being smart by waiting for a crash, but I realized that the cost of waiting is often higher than the cost of a market dip. In the investing world, time is a literal multiplier. If you miss just the 10 best trading days of a decade, your total returns could be cut by 50%. I wish someone had told me that the market is a machine designed to transfer wealth from the impatient to the patient. Every day your capital stays on the sidelines, you are paying an invisible tax of missed compound interest. Even a small investment of $100 a month, growing at an average of 8%, creates a massive snowball effect over 20 years. The math does not lie. When you realize that wealth is built through time in the market rather than timing the market, your entire strategy changes. You stop stressing about the daily news cycle and start focusing on your 20-year horizon. This shift in perspective is what separates the retail gamblers from the professional investors. Stop waiting for the bottom. The bottom was yesterday, and the next best time is right now. Your future self will thank you for the dollars you invested today, regardless of the current price. Many people think they need a massive lump sum of $10,000 to start, but that is a lie. Starting with $10 today is better than starting with $1,000 next year. The compounding effect of 365 extra days is more powerful than almost any initial deposit. I wish I had understood that the most expensive thing you can own is a missed opportunity. Discipline beats intelligence every single time in the world of finance. There is a huge lie in the finance world that you should put all your eggs in one basket and watch that basket. For 99% of people, that is a recipe for disaster. I wish I understood earlier that diversification is not about getting rich quick, it is about staying rich. A truly resilient portfolio in 2026 needs to be anti-fragile. This means having assets that behave differently under pressure. When the stock market goes down, maybe your commodities or your rental income stays steady. I used to think having 5 different tech stocks was diversification. It is not. That is just one sector. Real diversification means spreading your dollars across different asset classes, different currencies, and even different jurisdictions. You want a portfolio that allows you to sleep at night even if the headlines are screaming about a recession. We look at the 60-40 split, but we modernize it. We add a 5% slice for high growth, high-risk assets, and a 10% slice for physical protection like gold or land. This strategy ensures that no single event can wipe out your net worth. It is about building a financial fortress that can withstand any economic storm. Protect your dollars first, and the growth will follow naturally. Many investors forget that the goal is not to win every single trade, but to never be forced out of the game. If you lose 50% of your portfolio, you need a 100% gain just to get back to where you started. That math is brutal, and diversification is the only way to avoid that trap. True wealth is built by avoiding big losses, not just by finding big wins. I wish I knew that a boring, diversified portfolio beats exciting, concentrated one over any long-term period. The hardest part of investing isn't the math. It is the person in the mirror. Your brain is biologically wired to make the wrong decisions with money. We are programmed to run when there is fear and buy when there is greed. I spent years fighting my own emotions before I realized that the best investors are the ones who automate their decisions. If you have to decide to invest every month, eventually you will have a bad month and you will stop. But if you set up an automatic transfer of $500 every payday, you remove the human element. Success in finance is boring. It is the result of doing the same correct things for a very long time. I wish I knew that chasing the next big thing is usually a trap. The real big thing is the consistency of your habits. As we move further into 2026, the noise will only get louder and the distractions will get more convincing. Your job is to stay the course. Wealth is not a sprint. It is a marathon where the only person you are competing against is your past self. Master your mind, automate your dollars, and the wealth will accumulate while you sleep. If you are ready to take control of your financial destiny, join me on this journey. You need to cultivate a mindset of abundance rather than scarcity. Scarcity makes you panic sell during a 10% dip. Abundance allows you to see that dip as a discount on future wealth. I wish I had known that my temperament mattered more than my IQ. The most successful investors I know aren't the ones who can predict the future. They are the ones who can control their reactions to the present. Stop checking your portfolio every hour and start focusing on your long-term vision. Subscribe to Ben on Money and let us build something that lasts for generations.